Good morning, good afternoon, and of course, good evening, traders from across the globe. Welcome to my 2512th edition of Short-Term Trading Live with Oscar. Sometimes we do long-term analysis here, but it's called Short-Term Trading Live with Oscar. Good evening, traders. We've got a video planned. I want to show you some great stuff. I was going to get out in front of the camera this evening like I did last night, but I have to tell you what I want to show you I think would be easier to show you in this format, a few charts. So, let's go over this very risky game that we're in. You never know what's going to happen, what report's going to come out. You never know who's going to do what these days. So never trade without stops. Put your stops in first and know the risks behind trading. All right, let's move forward. For trading on Thursday, Jan 5th, 2023. In last night's video, I basically showed you something that I say is not a good sign longer term thinking, next few weeks, months ahead, because NASDAQ is below the 200 bar moving average. Now, might not seem like much except for this. The Dow, the transportation average, the Russell, the E-mini S&P have all broken this 200 bar moving average about 6 times each since 2008. So all of our indices have smashed through the 200 bar average about 6 times over the course from 2008 till today. But the NASDAQ has not. Not at all. Not even during COVID. Look, this is the 200 bar moving average and this is the COVID smackdown. It's a weekly, so it doesn't seem like a lot, but it was a huge amount of points considering that we were at about 9,740 when the crack started, and it got all the way down to about 6,531 NASDAQ price. Big crack, but look what it did. It held at the 200 bar moving average. Now, if you go back in time, you've got to go all the way back to 2008-9 to see it happen again. It's the only time. That's it. Every other indice, if I take you on a journey like this, you'll see it crack the average about 6 times. On average, it breaks the average about 6 times. Not NASDAQ, it doesn't happen. Look here. It got below, made us feel good for a little while, but that was a test, and it's back below again. So, for thinking out the next few weeks, I don't like what I see, just like I didn't last night, because NASDAQ is below the 200 bar moving average. Now, let's go to shorter term thinking, like what we're going to do tonight for tomorrow. I just wanted to make sure I reiterated what we looked at last night. So, for trading on Thursday, Jan 5th, I say we go to shorter term trading like the Dow Jones Transportation Average, which has basically been doing a lot of leading of the other indices lately. Now, it's been in what we know as an Oscarism known as the F flag, which is like a bastardized bear flag because it's leaning in the wrong direction. And what happens when you break out of an F flag is that it goes in the wrong direction and basically you get F'd. Hence the name of the F flag. So if you're in a bear flag, a bear F flag, eventually it will break out towards the upside. The difference between a bear flag and a bear F flag is that the bear F flag can go on for a long time before it finally breaks out. So that's the only difference. Anyway, so a bear flag would be pointed more up like this. This is an Oscarism known as an F flag because it's pointing kind of in the wrong direction. All right. When you get out of the F flag, which is bearish while you're in it, it breaks out to the wrong end. Now, we are above it at the moment. Look. All right, so if we're above it and the OMNI has turned green, I don't have a choice. I have to take the trade, so we will be buying the dips for trading on Thursday in U.S. indices as we have a green OMNI for trading E-mini S&P, NASDAQ, Russell, and the gamut. So that's what we're looking at in the Dow Jones Transportation Average and or E-mini S&P NASDAQ. They all run in the same direction usually. So we're going to approach Thursday by buying the dips like OMNI wants us to and hope that we broke out of this F flag and we'll head back up. Short-term trading, right? 1 day's trading. Now, another idea for trading tomorrow would be this bad boy. Look at gold. Gold is starting to put in a performance. It is well above the 200 bar moving average, which doesn't happen all that often. But now that it is above, it's steady above, inside of another F flag in the opposite direction, breaking out of that F flag and just continuing on above it, it seems. And look what happened the last time gold got above an average that kept it in check. This average right here, you got below it and stayed below it for the entire drop on the way down. Whenever it came back up to it, that little dotted blue average, it stopped it cold. Right? Went back down, stopped it cold. Went back down, voila, we get above it. That was this average. Now, we're looking at the 200 bar moving average, which always presents a dynamic move when you get around it. And we are around it now, and the OMNI's green for trading on Thursday. So we like buying dips in gold as gold is holding above the 200 bar moving average. And what would be keeping it that way? This pretty little chart keeps it in check. The US dollar index. Now, look how happy the US dollar was. Oh, happy day, happy dollar, nice green. See this green channel? It's wonderful, and the dollar's so happy, and it went on for so long. And then right around this crossover area, where I've got this little black crossover thing, it turns from happy green to not so happy red. See it right here? Look, let me move some of this out of the way now. Right here, right in this crossover area, boom, it just turns into something ugly. It stops the upward movement and starts heading into this downward channel, and that's where we are now. And unlike gold, which is holding above the 200, we are below the 200 bar moving average. So dollar pushing down would make the price of gold go up inherently, right? Because gold and dollars have a relationship. It's not every single day, but usually if you drew something like a teeter-totter, if you will, in a playground. So let's say that this is my little illustration of a teeter-totter in a playground, and on this side you put gold, and on this side we can put the dollar, because that's how they work, inherent opposites of one another. Not every day, but that's basically dollars, or gold is priced in dollars. So if the dollar starts to head down on this teeter-totter, what happens is the price of gold starts to head up. And right now you've got the dollar heading down clearly below the 200. You've got the gold heading up clearly above the 200. So you're getting this sort of pressure from the fundamentals, and the technicals tell us the same. So not so happy dollar means should be happy gold, and we would be buying dips in gold. Thank you to the good old US dollar. Traders, I hope that helps. Please like, share, and subscribe to these videos. Please share them around the internet for me. We could use more viewers, and keep your emotions out of this game. Remember, stops are in. Emotions are out. Thank you so much for tuning in. I appreciate everything you guys do for me. I'll see you at my site, and please be careful out there.